On the surface, the American economy looks pretty resilient. But if you peel back that top layer, a familiar and dangerous pattern is starting to take shape. One that we haven't seen since the days just before the 2008 financial crisis. Millions of Americans are unknowingly sitting on a mountain of what you could call invisible debt. This is a threat that doesn't show up in the headline numbers or the rosy economic reports. And as the first cracks are beginning to appear, with credit card and student loan defaults spiking, the question is no longer if this will hit the economy, but how bad the crash will be when the full picture is revealed. This isn't about the debt you already know about. This is about the liabilities lurking in the shadows, uncounted and unreported, that are making our entire financial system more fragile than anyone wants to admit. Today, we're dragging them into the light. When we talk about debt, we usually think of hard numbers: a mortgage statement, a car payment, a credit card bill. As of late 2025, total US household debt has climbed to a new record of $18.59 trillion. That number alone is huge. It's made up of over $13 trillion in mortgages, $1.66 trillion in auto loans, $1.65 trillion in student loans, and over $1.2 trillion in credit card balances. But the real danger isn't just in these massive, well-documented figures. The true risk to the system is hiding in what isn't being counted. This is the world of hidden liabilities, a vast, murky ocean of obligations that make millions of households and businesses far more vulnerable than they look on paper. So, what does this invisible debt actually look like? It shows up in a few different ways, each one quietly adding weight to an already overloaded system. First, there are contingent liabilities. Does this sound familiar? You co-sign a car loan for your child or a student loan for a family member. In your mind, it's their debt. You don't factor that monthly payment into your own budget, but legally, you are 100% on the hook. That loan is a contingent liability. It only becomes your problem if they start missing payments. Now, imagine that scenario playing out millions of times over across the country. These co-signed debts create a hidden network of financial promises, a web that only becomes visible when someone gets into trouble and the co-signer is suddenly on the hook for a debt they never really considered their own. Then there's the world of unreported or underreported debts. Think about lingering medical bills that haven't hit your credit report yet. Or maybe a landlord has let deferred rent payments pile up. For small businesses, it's an even bigger minefield. We're not just talking about routine unpaid invoices, which are usually accounted for. The real danger lies in less obvious obligations, like unpaid payroll taxes, future costs from a pending lawsuit, or loan guarantees made to another company. These things often don't appear on standard balance sheets because of accounting rules that only recognize liabilities when they become probable and estimable. This means a company can look financially healthy to a lender or an investor, all while hiding a ticking time bomb of future payments. An auditor might find these, but often they only surface when the business gets a shock, and by then, it's too late. Finally, there's the danger hidden within the official numbers themselves. This includes the explosion of subprime credit. These are loans and credit cards given to borrowers with weaker credit histories, often with punishing interest rates. A bank's report might show a total dollar amount for auto loans, but it can hide the fact that a growing chunk of those loans are subprime, with a much higher chance of default. The same goes for high-interest credit cards, where soaring APRs can quickly trap someone in a debt cycle that's mathematically almost impossible to escape. These riskier credit products are like a sickness spreading through the financial system, masked by healthy-looking statistics, until the whole thing suddenly collapses. This isn't just a theory. It's a structural flaw that makes households incredibly fragile, ensuring that when the next economic shock arrives, the damage will be far greater than any official forecast predicts. For years, this hidden fragility has been building in the background, but now the warning lights are flashing. The idea of invisible debt is becoming a very real, very visible crisis, and you can see the evidence in the delinquency data. The numbers for late 2025 paint a picture of a consumer who is under serious pressure. Let's start with credit cards. Total credit card debt has hit a breathtaking $1.23 trillion. But it's the cost of carrying that debt that's crushing households. The average interest rate for accounts with a balance has soared into the low to mid 20% range. At those rates, you're not just paying back what you spent. You're fighting a tidal wave of interest that can add thousands of dollars to your balance every year. As a result, delinquencies are spiking. In lower income areas, the rate of credit card debt becoming seriously delinquent has surged, signaling concentrated financial pain. The auto loan market tells a similar and maybe even scarier story. With $1.66 trillion in outstanding loans, this sector is flashing some of the brightest warning signals. The problem is a perfect storm. During the pandemic, easy credit and inflated car prices locked millions into huge loans. A lot of those borrowers, who looked fine on paper when stimulus money was flowing, are now underwater. They owe more on their car than it's actually worth. The problem is most severe in the subprime market, where delinquencies have reached or are near record highs, in some cases even worse than what we saw in 2009. We're now seeing a surge in auto repossessions, a grim, real-world sign of this crisis unfolding. And then we have student loans. This has become a massive point of stress. After a long pause, missed federal student loan payments started getting reported to credit bureaus again. The result was an immediate statistical explosion. Recent data shows that nearly 10% of student loan debt is now 90 plus days delinquent, which indicates that millions of borrowers are in distress. Some analyses project that millions are on a path to default, which can lead to wage garnishment and crush their ability to get other loans. The impact is devastating. A borrower who becomes seriously delinquent can see their credit score plummet by 60 points or even more, which could lock them out of the financial system and make it nearly impossible to buy a home or a car. What makes this whole situation so dangerous is the domino effect. These aren't separate problems. The Financial Stability Oversight Council has noted that delinquent student loan borrowers also hold hundreds of billions in other types of debt, including mortgages. A default in one area starts a financial fire that quickly spreads. When a family defaults on a student loan, their budget gets squeezed, making credit card and auto loan defaults more likely. This is how the fragility of one household gets multiplied across the economy. It starts with one missed payment, then another, until millions of families have to cut their spending all at once. That sudden stop in consumption is exactly what can turn a slowdown into a full-blown recession, just like we've seen in past financial crises. If all of this is giving you a sense of déjà vu, it should. This dangerous mix of massive, poorly understood debt and rising defaults isn't new. We're seeing an echo of the two biggest economic collapses of the last 100 years, the lead up to the Great Depression in the 1920s and the global financial crisis of 2008. In both cases, the real scale of the risk was hidden in plain sight, covered up by official optimism and financial products that almost no one understood. Think back to the Roaring '20s. On the surface, it was a time of amazing prosperity. But underneath, American families were taking on debt like never before. They borrowed to buy the new wonders of the age, cars and radios. And more dangerously, they borrowed to gamble on a soaring stock market. This explosion of household credit created a very fragile foundation. While many complex factors were at play, when the stock market crashed in 1929, that high level of debt acted as a massive accelerant. Families who were overextended got wiped out. They stopped spending, which caused businesses to fail, which led to mass unemployment. The debt didn't cause the crash, but it turned a market correction into a decade long economic disaster. The lesson was clear: widespread, unchecked consumer debt can pour gasoline on any economic fire. Now let's jump to the mid 2000s, right before the 2008 crisis. Again, the economy looked strong, but the real story was in the housing market, where a similar pattern of hidden liabilities was playing out. The invention of mortgage backed securities allowed banks to bundle thousands of home loans together and sell them to investors. The fatal flaw was that many of these bundles were stuffed with subprime mortgages, loans made to borrowers who were very likely to default. This was the invisible debt of its day. The risk was sliced up and spread so far across the global financial system that nobody knew where the poison was hidden. Credit rating agencies gave these toxic assets their highest AAA rating, calling them perfectly safe. It was a house of cards. When homeowners started defaulting on those subprime loans, the value of those mortgage backed securities collapsed. Financial institutions that were loaded up with them, from local banks to Wall Street giants, suddenly found themselves on the verge of bankruptcy. The dominoes fell, sparking a crisis that froze the world's credit markets and threw us into the deepest recession since the 1930s. The parallels to today are hard to ignore. Once again, we have record household debt. Once again, a big chunk of that debt is in high risk subprime products, especially in auto and credit cards. And once again, we have hidden liabilities, co signed loans, unrecorded business debts that are hiding the true financial health of millions of families. History teaches us that it's these pockets of hidden risk that cause the most damage. When leverage is high and poorly understood, even a small shock can set off a chain reaction of defaults that overwhelms the entire system. The pattern is repeating, and to ignore it is to ignore the most painful lessons of our own history. Understanding the scale of this invisible debt crisis is step one. Step two is knowing what to look for and how to protect yourself. This isn't about predicting the exact day a crash will happen. It's about seeing the warning signs and making smart, defensive moves with your money. These ideas apply to everyone, whether you're an individual, a family, or a business owner. First, for individuals, it's time to get radically honest with yourself about your finances. The whole problem we're talking about is unseen debt. So, your first job is to make everything visible. Pull your full credit report from all three major bureaus. Don't just glance at the score, read every single line. Are there any accounts you forgot about? Any co signed loans? That student loan you co signed 10 years ago is your liability, and you need to know where it stands. This simple checkup is your first line of defense. Next, you need to stress test your own budget. The data shows that households where a huge chunk of income goes just to paying off debt are the most vulnerable. A common red flag is when your debt payments eat up more than 40% of your income. The advice here is as old as it is true. Build an emergency fund. Having cash on hand is the single best defense against an economic shock. Because it stops you from having to rack up high interest credit card debt to cover a surprise bill. Then, get aggressive about paying down high interest debt. Credit card balances with 20+% APRs are a financial emergency. They're designed to keep you trapped, and you need to prioritize getting rid of them and be extremely careful about taking on new contingent liabilities. Co signing a loan isn't just a nice gesture, it's a binding financial commitment that can put your own future on the line. For small business owners, the same ideas apply, but the stakes are higher. You need to do a forensic audit of your own books. Go beyond the standard balance sheet. What are your true liabilities? Account for all accrued payroll, unpaid vendor bills, and any potential costs from lawsuits or warranties. Many businesses fail not from a lack of sales, but from a sudden cash flow crisis sparked by a liability they never planned for. And if you're thinking of buying another business, this level of deep dive is non negotiable. Insist on audited financials and demand full transparency on any off balance sheet deals or hidden liabilities. Finally, what are the key numbers everyone should be watching? These are the early warning signs of a deepening crisis. Keep an eye on the 30 and 90-day delinquency rates that the New York Fed publishes for credit cards, auto loans, and mortgages. If those rates keep rising across the board, that's a major red flag. Watch for reports on what share of new loans are going to subprime borrowers. A jump there shows that lenders are getting riskier, which often happens late in an economic cycle. And pay attention to data on household savings and debt service ratios. When savings fall and the cost of debt rises, it means the consumer is stretched to the breaking point, and the economy becomes incredibly vulnerable to the slightest push. Investigating these trends is what we do. We believe that knowledge is the best defense against financial instability. If you found this analysis valuable and want to keep getting in-depth research that cuts through the mainstream noise, make sure you're subscribed to the channel with notifications turned on. And if this video gave you a new way to look at the economy, hit the like button to help us get this crucial information out to more people. The story of the American economy in 2025 is a story of a dangerous disconnect. On one hand, you have headline numbers that suggest everything is fine. On the other, you have a foundation filled with the invisible cracks of hidden and high-risk debt. From co-signed loans and deferred payments to the alarming rise of subprime credit, millions of households and businesses are far more fragile than they seem. The spiking delinquencies in credit cards, auto loans, and student loans aren't just isolated data points. They are the tremors before the earthquake. They are the first visible signs that the immense pressure of these hidden liabilities is starting to fracture the system. History showed us in 1929 and again in 2008 that the worst crises are born from risks that everyone underestimated or simply ignored. The parallels are chilling. High leverage, hidden vulnerabilities, and a chain reaction of defaults just waiting for a trigger. When a huge part of the population is this financially fragile, the entire economy is operating on borrowed time. The signs of an invisible debt crisis are all around us. And the only question left is how much damage it will do when it finally steps out of the shadows.